Hey, it's Realtor Jess here to talk about down payments, how much you need, and how to get someone else to pay for it. A lot of people are surprised to learn that the minimum down payment needed is only 3%. You heard that right, just 3%. 3% is what's needed for Fannie Mae's Home Ready program, which you can use if you are borrowing up to $484,350. Your credit score is at least 620, and your income is less than 80% of area median income. So in DC, that's about 95,000. So if you're earning less than 95,000 and you have a 620 and you're borrowing up to 484,350, you can get a mortgage with just 3% down. If you're like, Jess, that sounds good, but my credit score isn't exactly a 620, don't worry. You can use FHA. FHA only requires a 580 credit score and has a minimum down payment of just 3.5%. And you can use $726,525. That's how much you can borrow with an FHA. So, however, if you're like, oh, I watched your earlier video and I don't know about that mortgage insurance premium that stays on for the life of the FHA loan, then a 5% conventional might be for you. The 5% down conventional allows you to also borrow up to $726,525 as long as your credit score is at least 620. So there you have it. If you're borrowing up to $726,525, you can get a mortgage with 3% down, 3.5% down, or 5% down. Why not 20%? So the old adage from our parents' day of yesteryear was that 20% was the minimum down payment. But it's a new day. And putting down 20% really doesn't get you that much better of an interest rate. And to me, the cost-benefit trade-off just isn't worth it, especially since mortgage insurance is so cheap now. So you know that if you put down less than 20%, you have to pay what's called private mortgage insurance each month. That's to compensate the lender for the extra risk of lending to someone who doesn't have as much skin in the game, right? On a conventional loan, that comes off at about 80% loan to value. On an FHA loan, that amount never comes off. But let's talk a conventional loan here. On a $400,000 home, that PMI is going to be, what I've seen today's conditions would probably be about $120 a month, right? So a lot of this depends on your lender, depends on your credit score, but let's just say $120 a month. So, if you decide to pay 20% down when you really only had to pay like 3% down, you're paying 17% more than necessary just to avoid paying an extra $120 a month. So on a diagram here, so 20% minus 3% equals 17%. So on a $400,000 home, this extra 17% comes up to about $68,000. That's how much more you'd be paying to put 20% down. And this $68,000 divided by your $120 savings would mean it would take you 566 months or 47 years and 3 months for this decision to pay off, right? That's literally longer than the mortgage. The mortgage is 30 years. It would take you 47 years for this decision to pay off. That just doesn't even make any sense, right? Especially when you could take that $68,000 and invest it in the market at a better rate, right? So historically, the stock market increases at about 8% a year. But you're sitting here trying to pay down a 3.5%, 4% mortgage. That's crazy. At 8%, that's $68,000 over 30 years. In 30 years, if that $68,000 increased 8% each year for 30 years, at the end of that mortgage term, you would have $684,260. That's more than what you pay for the house just from not throwing it away on extra down payment. Think about it. So I know you're wondering, where is this money going to come from? Okay, that's cool, only 3% down, but on a $400,000 house, that's still $12,000, and I'm just struggling to get by to pay my bills. So where is this money going to come from? The short answer is you, someone else, or your state, but probably a mix. A lot of this also may depend on timing. So your down payment is actually really broken up into two parts. So the first part is a 1%, what's called earnest money deposit, within usually 3 to 5 days of going under contract. So 1% is generally paid upfront. Then at the closing table, 3 to 4 weeks later, you pay the remaining, 2%, 2.5%, or 4%. So some people will use savings that they have in the beginning to pay the 1% and then get money from another source to cover the extra 2, 2.5%, 4% at closing. Let's walk through all of these. The first option is from you to take the money from your own sources. So that could be your savings account, that could be your investment account. In particular, that could be your IRA account. So a lot of people don't realize that you can take out up to $10,000 without penalty from your IRA account to purchase a home if you haven't owned a home in the last 2 years. Do your research, because these rules differ for traditional versus Roth IRA, and depending on how long you've had the account open. But it's definitely worth looking into if you have great investments in your IRA. Also, your retirement savings, like your 401k plan, your TSP plan, if you're here in DC working for the government, your 403b, if you're working for a school system. You can generally take a loan from your retirement plan, and the interest is paid back to you. The loan is usually at a very minimal amount and does not appear on your credit report. So if you're like, oh, I need to, just take this $10,000 really quickly and pay it back to myself over time, that's also a really great way to access funds that you already have. Another great way to get money for your down payment is from someone else. A lot of people don't realize that you can get unlimited gift funds from relatives. So that can be used for all or part of your down payment. Now, it must be a relative, a fiance, or a domestic partner. So someone who has some kind of love interest in the transaction. And they have to sign a 1-page gift letter to say it's not a loan, it's actually a gift. Another great sort of approach to this is wedding gifts. I just attended a friend's wedding this past weekend, and a lot of people bring gifts. A lot of those gifts are cash. And so if you put that money in your account, you let it season for a couple of months, and then boom, you have your down payment, in part or in whole, just from the gifts of loved ones who, want you to get off on a great start. The last approach here is employer incentives. So some employers, private employers, and public employers will offer down payment assistance for their employees. Here in DC has the Employer Assisted Housing Program called EAP. EAP gives up to $25,000 for DC government employees to help with their down payment, closing costs, and they also give an interest rate discount if you're interested in that program. So getting money or an incentive from your employer can be a great way to help with your down payment. The last great way to get money for your down payment is from the state that you're moving to. So most states have some kind of down payment assistance program, and your eligibility will depend on your income and your credit score and even your household size sometimes. Here, I'm going to focus on DC, Maryland, and Virginia because that's where I am. And I'll put links for each state's website so you can dive deeper into their specific programs. But let me give you an overview. So DC has two great programs. The first is called the Home Purchase Assistance Program, HPAP for short, in which you can get up to $80,000 of down payment assistance depending on your household size and your income. So for a household of one, the max income is about $93,000. And for a household size of two, it's a little over $106,000. So if your income is below those, you could get money from HPAP. The other great program is DC Opens Doors, and that one has a max income of $140,000, $140,640 to be exact. And DC Opens Doors will pay your 3 or 3.5% down payment in a 0% loan. 20% of that gets forgiven each year that you live in the house. So you live in the house 5 years, it's all forgiven. So DC, you're looking at HPAP or DC Opens Doors. Unless you're a DC government employee, and then you also want to check out EHAP for that extra $25,000. Maryland. So Maryland has the most programs. Actually, they just generally umbrella it as the Maryland Mortgage Program, but it's a lot of programs. They have 3% grant, 4% grant, and they also cover county-specific programs as well. So in Prince George's County, you can get up to $10,000, and in Montgomery County, you can get up to $25,000. My favorite M&P program is one called Smart Buy 2.0. And with this program, you can get up to $40,000 to pay off your student loan at closing when you buy the house. It's pretty incredible, but it is a little complex, so we'll definitely have to work closely on that. In Virginia, BHDA, the Virginia Housing Development Authority, gives a 2 to 2.5% grant depending on where you are in the state and your income and household size. So the best way to know your eligibility is to check your eligibility using the buttons below to check out the websites for the agencies themselves. All right, time to recap. Now you know the minimum down payment is 3%, 3.5%, or 5%, depending on your credit score and your loan amount. Now you also know that you can get down payment money from yourself, someone else, or your state. Click the links below for more information on the specific programs. Lastly, I want you to know that you are not alone. Your realtor and your lender are here to help. I shut down my financial planning business so that I could share my financial expertise with my real estate clients exclusively. So if you need help strategizing on how to come up with your down payment, schedule a time to ask questions at the link above. Let's strategize and find out how we can make your homeownership dream come true. Thanks so much for watching to the end. You are truly helping this queen achieve her dream.